Welcome back to your 5-minute Seattle real estate monthly update. In this channel, we cover everything here you need to know as a real estate investor in the greater Seattle area. Please also follow us for our 1-minute weekly updates. So major shift is happening right now in the real estate market as we speak. As we covered previously, on March 16th this year, the Fed raised the federal fund rate by 0.25%. This month, we saw another 0.5% hike, and we're likely to see even more increases throughout the rest of the year. How did the market respond? The mortgage rates have increased for 10 weeks in a row, and currently, the interest rate for a 30-year fixed mortgage is over 5%. Also, with the higher rates, refinance applications dropped by 62%, and purchase loan applications dropped by 9% from the same time last year. Nationally, for real estate, according to Redfin, the share of home sellers who dropped their asking price shot up to a 6-month high of 15%, compared to 9% a year earlier. For home buyers, the typical monthly mortgage payment skyrocketed a record of 42%. However, despite of signs of softening demand, the housing prices continue to climb. In the US, median home sale prices was up by 17% year over year, which is the biggest increase since August 2021. So locally, how is this impacting the Seattle real estate market? The median price home in King County currently costs around $999,000, and compared to a year ago, this is roughly an increase of 19%. For the properties that were sold, they were on the market for 5 days on average before accepting an offer. This number has stayed the same for the past 3 months. For the properties that were sold last month, they were closing at right around 110% of the asking price, which means the sellers were getting roughly on average 10% over what they asked for originally. When we compare how many homes that are currently on the market for sale to how many homes that were closing, there's roughly 0.4 months supplied. As balanced market is between 4 to 6 months, we're definitely still in a strong seller's market. Despite of the recent spike in interest rate, some buyers who need to buy are trying to make a purchase before the interest rate goes even higher. So what does this mean to home buyers and property owners today? So far, the data is showing definitely a softening of demand, but housing prices are still going up. Well, in other words, we're currently in the state of price deceleration, not price depreciation. However, this also means buyers are being squeezed from all sides. On one hand, a 1% increase in interest rate translates into roughly 10% decrease in buyers' purchase power. On the other hand, housing prices are continuing to get higher and higher, which begs the question, what should the buyers do now? As an owner of a real estate company and a real estate broker for nearly 20 years in the Seattle area, here are my 3 tips for today's home buyers or investors. In real estate, timing the market beats timing the market every single time. Real estate is not as liquid as stocks or other securities, and the transaction cost is very high. So timing the market is especially risky. Therefore, put yourself in a position that you can hold on to the real estate for the long term. This way, you can choose to sell the property when it fits your financial objective and not be forced to sell when you don't want to. For a lot of people, that means to seek steady employment and, more importantly, save enough in your reserves for your rainy day fund. Number 2, stick to the fundamentals. When choosing which real estate to purchase or invest, buyers are always balancing primarily between 3 things, assuming you don't have an unlimited budget. One is size, location, and characteristics of the property, such as age, quality, and condition. So, in a downward market, it's proven time and time again, the value of your real estate is more resilient when it's in a prime location. So within reason, prioritize location in your criteria and choose as good of a property you can afford within your budget. Number 3, have a strategy to mitigate your risk in the case of a worst case scenario. For example, what happens if you were to lose your job or you have to move out of state? As mentioned earlier, we want to be in a position that you would not be forced to sell in a downward market unless you want to. One strategy is to do a cash flow estimate before you purchase a property, even if you plan to live there. Ideally, you want to be in at least a cash neutral position, which means your potential rental income can offset your operating expenses related to your property. So even if you have sudden change in your employment or you have to move away, you can more easily ride out the downturn and not have to sell at a loss. As always, thank you so much for watching. Hope you find the information helpful. Please subscribe for our weekly 1-minute updates. I'll see you next time.